A grim snapshot of the holiday shopping picture for Walmart. The retail giant confirmed same-store sales fell in November for the first time in a decade. But while Walmart is slumping, other stores are soaring.
It looks like one of General Motors' biggest investors may no longer own any shares in the automaker. We'll tell you why a huge block trade of 28 million GM shares late today has Wall Street wondering tonight.
This man will take the helm of the House Financial Services Committee in January, and he says his top priority will be making sure the nation has affordable housing. We sit down with Congressman Barney Frank.
Also, saving power while producing Pinot Noir. As we wrap up our series, Power Struggle, we'll show you how California is working to find new sources of renewable energy.
I'm Paul Kansas.
And I'm Susie Garib. This is Nightly Business Report for Thursday, November 30th.
Nightly Business Report is made possible by
Franklin Templeton Investments, providing a unique perspective through the specialized investment expertise of Franklin Templeton Mutual Series and Fiduciary Trust. Franklin Templeton Investments. Gain from our perspective.
And by A.G. Edwards.
This program was made possible by contributions to your PBS station from viewers like you. Thank you.
Good evening, everyone. Looks like the holiday season got off to a not-so-jolly start for many retailers. Today, they posted weaker than expected sales for November, and the big loser was Walmart. The world's largest retailer reported a drop in November sales and warned December sales will likely be weak as well. But as Erica Miller reports, some analysts are still optimistic about the holiday shopping season.
Walmart issued a grim outlook for holiday spending, and that's raising concerns about the outlook for the season as a whole.
I think that the weakness in Walmart does in fact represent some weakness in the overall economy. Consumer confidence recently started to soften a little bit, again, indicative of a trend towards slower economic growth.
The discount giant warned today that December same-store sales will likely be up 1% at most. That's on top of news that sales fell 0.1% in November, their first drop in 10 years. Analyst Bob Buchanan, whose company has done business with Walmart over the past year, blames the weak sales figures on a poor merchandise mix, among other things.
I think you have to draw a line between Walmart and the industry. And for the first time in a long time, Walmart steadily has been losing market share. And I can assure you that this company is all about gaining market share.
What's clear is that many chains struggled during the month, including the Gap, where sales fell 8%. What's worse, the Gap expects pressure on profit margins to continue through December. Analyst Dorothy Lochner, who owns shares of the Gap, blames bad fashion bets.
I think they're realizing that the product didn't have enough color for holiday. It's a very neutral color palette. People want colors around the holiday season.
But there has been one bright spot in retailing, luxury retailers like Saks, where sales rose more than 7%. Experts say that's because shoppers at those stores are generally less sensitive to higher oil prices and rising interest rates. November marks the kickoff of the holiday shopping season, but December is far more important to retailers. In the past 2 years, roughly 80% of holiday spending has occurred during December. Erica Miller, Nightly Business Report, New York.
Those soggy retail sales put a damper on stocks this morning, as did a lower dollar and higher oil prices. At noon, the Dow was off 55 points, while the Nasdaq posted a 6-point loss. The market turned choppy this afternoon on end-of-month window dressing activities. The major indices traded briefly in positive ground, but then ended narrowly mixed. The Dow Industrial Average lost 4.80 at 12,221.93. The Nasdaq Composite was off 0.46, ending at 2431.77. Standard & Poor's 500 index gained 1.17 to 1400.65. In the bond market, the 10-year note rose 16/32 to 101 and 10/32, putting the yield all the way down to 4.46%.
Corporate America is at a competitive disadvantage compared to global rivals. That's the conclusion of a panel of leading academics and businessmen. The Committee on Capital Markets Regulation released a report today saying the U.S. needs to reduce regulation so the nation's capital markets can remain competitive. But the group stopped short of advocating changes to the Sarbanes-Oxley Act, which American businesses complain is too expensive and time-consuming to comply with. Other recommendations? Reducing corporate exposure to class action lawsuits and enhancing shareholder rights.
If Wall Street wants some kind of legislative relief, it will have to work with Congressman Barney Frank, the incoming chairman of the House Financial Services Committee. Washington Bureau Chief Darren Gersh sat down with Frank today and began by asking what needs to be done to keep U.S. financial markets competitive.
I accept the fact that there is a problem. There's been a diminution in the percentage of deals that are done here and the companies that list here, et cetera. So I think the thing for us to do is to have comprehensive hearings about it and to see what the reasons are. Now, one thing I have agreed to for some time, which is to encourage the SEC and the Public Company Accounting Oversight Board to reduce the amount of information that has to be processed through Section 404 of Sarbanes-Oxley. I do think, look, it was a new law that was passed, and not surprisingly, it needs adjustments. I don't think it needs statutory adjustments. I don't think anybody who's now covered should be exempted entirely. But I believe that under the existing rules, the SEC and the PCAOB can make it less burdensome.
One thing they did talk about is CEO pay. And they say, look, wait until we see what the new disclosures are that the SEC is going to require. They're going to have this total figure. For the first time, we'll see the total compensation figure disclosed in the coming year. Don't take action on CEO pay until we see what those numbers are. CEO pay is an issue for you. Is this something you want to wait until you see what these numbers are? Or do you think you want to act quickly on it?
No, I don't think we should wait. First of all, if we listened to the people who said don't do anything, we wouldn't have the numbers. Beyond that, what I think we should do, I don't need to wait to see what the numbers are. I don't want to set the numbers. I don't think the government should be telling people what to pay. I do think the shareholders should. The point I would make is this. With regard to CEO pay in particular, I do not think the boards of directors work as effective independent checks. They are not the fox guarding the hen house. They are the hens guarding the rooster. And I think the time has come to say we need the shareholders to do this. What we're proposing is not one size fits all, one uniform rule. We're saying let the people who own those companies vote for it. It seems to me a distinctly non-radical idea.
Well, you're going to have jurisdiction over many industries in the financial services sector, insurance, banking, housing. What's your top priority?
Affordable housing is the single biggest one. We have a terrible housing crisis in this country, and I think we now understand that housing is not simply a social good, but it's an economic factor. The biggest difference people will see when we take over from the Republicans is we will reverse their policy of basically letting any affordable housing stock dwindle and not building any new stock. A related issue there is the question of predatory lending. We now have data from the Home Mortgage Disclosure Act that my former colleague Joe Kennedy worked so hard to enact. And it now is pretty clear. If you are African American or Hispanic, you have less chance of getting a mortgage, and if you get one, you have a high chance of paying more, even with other factors being equal. That's not right. I think that's got to be a very high priority.
If you can, I know you've talked about a grand bargain that needs to be struck in our economy going forward. Can you boil that down for our audience and explain to them what you mean when you say a grand bargain?
What you've got is a kind of a double veto now. The business community, which has been in control politically for a long time with its allies, has blocked our efforts to do anything about equity. They've frustrated the National Labor Relations Act. You can't join a union these days. Health care is dwindling. People's pensions aren't what they used to be. Real wages have actually slipped some. The minimum wage hasn't been brought up. On the other hand, the people who care about equity have been able to block foreign trade, foreign direct investment, et cetera. I want to say to the business community, look, help us get health care out of the workplace and have a good universal health care system. Let people join unions without being harassed and the obstacles. Raise the minimum wage. Help more people get higher education, partly through public spending. And in return, let's go do trade agreements, although with some environmental and labor protections. Let's allow foreign direct investment without restriction. That's what I want to do. I want to get the people who've been concerned about equity to support growth policies and the people who've been chafing that we aren't doing enough for growth to support policies that provide equity.
Congressman Frank, thank you for your time.
You're welcome.
The state of California wants to be a leader in renewable energy, so it's launched ambitious plans to boost energy efficiency, increase sources of renewable energy, and cap carbon dioxide emissions. But as Stephanie Du reports in the conclusion of our series, Power Struggle, just how to meet those goals is a struggle itself.
Homebuilder Lennar is constructing these houses with solar roofs. The move is in anticipation of a solar initiative by California that requires new homes have solar roofing as an option by 2011. Lennar's Sherman Haggerty says state and federal incentives help make solar an attractive sales point now.
I believe as people get more comfortable with how to manage their electric and understand that they are a power producer as well as a power user, they'll be able to have a very significant impact on their energy bill.
Some businesses are already seeing a significant impact on their energy bills. Domaine Coneras Winery made the decision to buy a solar system for its Pinot Noir facility 3 years ago.
Using the solar system saves the winery $90,000 a year. At that rate, and with state and federal incentives, the system should pay for itself in 5 years.
Eileen Crane is the CEO and chief winemaker at Domaine Coneras. She has become a point person for solar in Napa Valley.
When it started to be known that we had put it in this system and started, so to speak, lit it up, there was an overwhelming press for information on our collection system. And we saw within a matter of a few months people putting in systems as big or even bigger.
The push for solar is part of an ambitious program in California to boost energy efficiency, increase renewables, and cap greenhouse gases.
We're both hopeful and pretty confident that what it means is it's going to lay the path to a sustainable future that's not just good for the environment, but also good for the economy.
But not everyone agrees. Manufacturers support the solar initiative, but worry the cap on greenhouse gases could push up energy prices. Past policy mistakes have contributed to California's high electricity prices, which are 45% above the national average.
So the companies that are surviving and doing well in California have already adopted very aggressive energy efficiency measures. So we're talking about gold standard companies that are doing all they can do and stay profitable in terms of energy use. When you're adding even more cost burden, you're putting them really outside the ballpark of being able to survive.
And some businesses fault politicians and policymakers for not doing enough to address a key source of California's greenhouse gas emissions, cars. Tesla Motors has designed and is marketing an all-electric car. The $100,000 Tesla Roadster will hit the roads next year, and in 2 years, the company plans to roll out a sedan in the $50,000 range.
And you can put 1 million solar panels on our roofs, and it will reduce California's oil consumption by not one drop, unless we have electric cars, because we don't use oil today to make electricity.
California wants to be a driving force behind a new energy future with less dependence on fossil fuels and abundant supplies of renewable energy. But it, like the rest of the nation, is facing a power struggle, balancing the energy needs of a growing economy with the impact on the environment. Stephanie Du, Nightly Business Report, San Francisco.
Now let's take a look at some stocks in the news tonight. Once again, big board volume leader today on 42.6 million shares. Lucent Technologies down 2 cents. Alcatel completed its merger with Lucent today, so tomorrow the new company will trade as Alcatel Lucent and the trading symbol will be ALU. Then came General Motors, very active and down 27 cents. Now, GM's biggest shareholder may soon own no GM shares. Billionaire investor Kirk Kerkorian's Trescinda Corporation told the Wall Street Journal late today that it plans to divest its entire stake in GM. That works out to about 28 million shares, or almost a 5% stake of the company. Trescinda has already sold 28 million GM shares this week, and there was a late-day sale of 28 million shares, which are believed to be Trescinda's. Then came Pfizer, up 42 cents. The company boosted its 2006 earnings estimate by a nickel to $2.05 a share. Nortel Networks, no change there. Quest Communications down 14 cents, fifth in volume. ExxonMobil up 78 cents. Time Warner dropped 19 cents. EMC a 23-cent gain. AT&T moved up 41 cents. And then Alcatel, a 3-cent gain, 10th in volume. Standard Pacific up $2.40. Now, first of all, Bank of America upgraded the home building group from underweight to neutral, and specifically this company, Standard Pacific, got an upgrade from sell to a buy. And there were upgrades on 4 other home builders, and the upgrades were all the same from Bank of America, from sell to neutral. Meritage, NVR, Pulte Homes, and Ryland, all very nice gains. JCPenney, one of the weak retailers, off $2.26. November same-store sales were only 1.4% ahead of last year. The street was expecting a 4% rise. Then came Christopher & Banks, the women's apparel retailer, down $1.54. November same-store sales there dropped 8%. The street was looking for a drop of only 1.6%. DSW Incorporated did very well. The footwear retailer came in with third-quarter earnings of 36 cents. That's 9 cents above the street estimate and well above the 25 cents last year. Then we see Cardinal Health moving up $2.79. The company will divest its ailing pharmaceutical technologies unit, and Deutsche Bank Securities upgraded the stock from hold to a buy. And then Gerber Scientific moving up 13 cents, traded as high as $14.99, had a second quarter turnaround, earnings of 16 cents versus a penny loss last year. Most active NASDAQ, Apple Computer down 14 cents, followed by Google with a 16-cent gain. Research in Motion up $4.68. Starting tomorrow, Singular Wireless will start selling RIM's company's BlackBerry Pearl device. Microsoft, 21-cent drop. Cisco fell 17 cents, fifth in dollar volume. Intel, 16-cent gain. IAC Interactive was up 47 cents. It will replace Lucent in the Standard & Poor's 500 as of tonight. Amgen down $1.38. A 6-cent loss in Qualcomm, 10th in volume. Broadcom fell a nickel. Digital Insight up $5.15. Intuit will acquire this company for $39 a share in cash. And over on the American exchange, Xenonix Holdings, involved in high-intensity lighting, expects to report significant rise in fourth quarter revenues and profits in mid-December. Those are the stocks in the news tonight. Susie?
Paul, Microsoft formally released its Windows Vista and Office 2007 products to big business customers at the NASDAQ Market Center in New York today. That's where the software maker's CEO, Steve Ballmer, talked with New York Bureau Chief Scott Gervey. Scott began by asking Ballmer how he felt about getting these long-awaited products finally up and running.
A day of excitement and enthusiasm, I would say. I mean, to have the 2 most significant products at Microsoft have this unprecedented wave of innovation and accompanying products. We've got over 30 other products besides Windows and Office we're shipping today. It's exciting.
And we've talked to a lot of people who've done extensive testing already, and the reviews are very good. I mean, they're uniformly good. Do you think that the rollout will be faster than in some of the previous versions for Windows and Office?
I do, as a percentage of the installed base. Of course, the installed base continues to grow every year, so I think it'll be faster as a percentage of the installed base, and I think that means, very, very good things. But at the end of the day, we got to continue to get out there and help our customers drive the value.
And so it'll be a quarter or 2 before you begin seeing these things on the bottom line.
Well, everybody's got to have their own financial model of how we benefit. In some senses, we've been shipping PCs with Windows, and we're going to continue to ship PCs with Windows, and yet there's a whole bunch more value around this that should drive revenue and earnings growth.
Something has been made, of course, of the long development time. It took 5 years since the last iteration of Windows, Windows XP, and a lot of that had to do with building the stability and the security into the system. Do you see the next version coming faster? I mean, I almost hate to ask you that so quickly, but...
I certainly think you should anticipate a much shorter cycle between this version and the next one. That doesn't mean 6 months. Our customers don't really want Windows releases that quickly, but it won't be 5 years either.
And do you see it significantly different? I mean, there are people who are wondering whether you'll adopt some new kind of pricing strategies, the idea of services on the network, where some of these applications or some of the functionality will come from the network rather than from in the box. Do you see something that significant coming?
There's a lot of interesting things that will come. There's a lot of new hardware. There's a lot of new user experience. This notion of software as a service is very important, both to Windows and Office. And you'll see us make innovations in all of those areas.
This is a worldwide rollout, and the different language versions, everything's available right away.
Yes, everything is essentially, I say everything, and we'll be able to find obscure, less popular languages that are not available, but essentially worldwide immediately.
Is there a special version that had to be made to satisfy the requirements of the EU?
We have a special set of things that we have to do based upon the EU decree around media players. But other than that, no, we designed a product that we could roll out essentially globally based upon our reading of European law and the help we got from the Commission to interpret it.
So you've worked with them and you don't anticipate problems like that?
That's correct.
Let's talk just a little bit about the rest of the company, because while this is such a big part of it still and such a big announcement, we've got so many other new things out there. We've got Zunes, we've got Xboxes. What's going on the consumer side, and how do you maintain the focus as this organization gets bigger and gets more diverse?
Being bigger actually helps you maintain a focus on multiple things. Not everybody's got to know about everything going on. We've got people driving on Windows and Office. We've got people who are building out a business, an enterprise business. We've got guys who live, breathe, and sleep data centers and online operations and advertising. And we have a bunch of guys who just sit there and say, how do we entertain people? Where's that going? What do we need to do with the Zunes and the Xboxes and the media center PCs of the world? And in some senses, I think we have, I call them our 4 muscles. We want to have 4 strong muscles and be able to serve our customers in a broad set of ways.
Stock's been up a little bit in the last couple of quarters, I think, in anticipation of some of this. I know you're not going to go ahead and predict stock prices, but you've got space to expand the multiples, at least, as you look forward?
Well, how the multiple goes is always up to the market. I focus in on the innovation, the revenue, and the growth. We've about doubled our earnings over the course of the last 5 years or so. We're one of the most profitable companies in the world, top couple, 3 companies in the world. We've got our heads down innovating and trying to drive revenue and earnings growth, and the rest of it will take care of itself.
Very good. I thank you.
Thank you very much.
Tomorrow, our Friday Market Monitor guest is John Murphy, Chief Technical Analyst of StockCharts.com.
Here's a look now at what's happening tomorrow. Federal Reserve Chairman Ben Bernanke speaks in Washington, D.C. Also tomorrow, November auto sales, the November manufacturing index, and October construction spending. And finally tonight, 'tis the season for holiday gifts, and when co-workers exchange gifts, some could be in for a surprise. A new survey asked executives to describe the most off-the-wall gifts they have seen. Among the responses, a life jacket, frozen potatoes, and a stuffed rattlesnake. Also on the must-miss list, a goat a pot holder, and a life-size poster of John Wayne. But sometimes workplace gifts can be great, like the new car given by a CEO to his assistant. Paul, the research firm that did the survey, the Creative Group, says when shopping for coworkers, think small and think practical. But you really don't want another tie from me. Don't you want that goat?
I had my heart set on the stuffed rattlesnake.
That's Nightly Business Report for Thursday, November 30th. I'm Susie Garib. Good night, everyone. Good night to you, Paul.
Good night, Susie. I'm Paul Kangas, wishing all of you the best of goodbye.
Nightly Business Report is made possible by
Is your nest egg in shape for retirement? Objective Financial Advice can help. A.G. Edwards, for more than 118 years, fully invested in our clients.
Franklin Templeton Investments. After 50 years of worldwide investing, we see market opportunities through the eyes of experience. Franklin Templeton Investments. Gain from our perspective.
This program was made possible by contributions to your PBS station from viewers like you. Thank you. For more information about investing, you may order Nightly Business Report's home video, The NBR Guide to Buying Bonds.